So when you hear the word liquidity, and it is something that you will see in everyday news, just think more liquid means more easy to sell. Immediate na cash ravali. Liquidity means cash. Okay, when we say this is a very illiquid asset ante, you cannot easily convert into a cash. It's an asset. I have a old, antique, some car or something. No, it is very difficult for me to sell because ultimately I need to find that kind of a buyer. But I can sell the land more easily. I can sell gold even easier if I have cash, nothing like that. So when you're thinking of liquid, think cash. Expansion and contraction vis-a-vis liquid. I just told you what does contraction mean. One, contraction means fewer goods, but also if liquidity is sucked out also, the economy tends to contract, because if you are removing cash from the system, then there is fewer notes to do the transactions. Okay. Free flow of demand and supply across sectors, respective financial institutions. Okay. Liquidity also allows for a free flow of demand and supply. If there is enough liquidity, when there is a demand and supply, immediately it will go. But if there is not enough cash, even if there is a demand, there is a supply, that transaction is not going to take place because it is not liquid. Okay, because there is not enough liquidity in the system. Okay, there is not enough cash in the system. Okay, now let's touch what are banks. Banks are financial intermediaries. There are people who want to lend money from some saving that I have, 5,000, 2,000, 1,000, 1 lakh. And there are people who want to borrow money, either because they want to buy something, but usually when we say borrower, we are referring to a businessman, because he wants to start a business. Borrowing is so that you can then invest, usually. But it need not be the case. Today, all your big companies offer, HDFC, say, bank, or SBI, it offers credit cards. So every time you are using a credit card, you are a borrower, right? But you use it for consumer durables, or you use it for like retail. You are a retail borrower. You are a retail saver also. Okay. Now you will have excess money. There are people who want to borrow. You can do it directly. You can go to a friend and say, you know what, I need 10,000, and he will borrow it. That is direct. But at the economy level, you have banks that act as a bridge between all those people who have savings and who are willing to lend, and all those people who want to borrow. They can directly come to the bank, and bank then acts. That is why bank is called a financial intermediary. And it is an institution that is less risky. If I give to my friend, he may return, may not return. And all of you may have experiences of this. Now, but if I give to my bank, adi kuda ekkadako veltundi, but I am also going to get my money back. Okay, it will give me interest also. There is a complicated way in which this risk is measured, but because banks are dealing with the general public, and that saving might mean life and death, that saving could be for students' education, that saving could be for my mother's health. Therefore, the government intervenes and regulates, or the RBI closely monitors bank, which is also a financial intermediary. It is financially intermediating between the two parties. It very closely monitors. And there are so many restrictions and regulations that are there for a bank. So it needs to keep so much reserve. It regulates it so that this is a safe option for people who are not willing to take risk. Okay? So financial intermediary minus risk, it means bank is a fairly stable institution and you can invest in it and you can keep it. Why reserves? I just told you, you need to have a certain amount of reserve. Any bank, take the best bank in the world, it doesn't matter. If all its clients go on the same day and ask for the money, it will collapse. Because no bank works that way. Banks only keep 15% cash reserve ratio. The rest of it they have lent to other people. to other institutions and individuals. So suddenly, if all my savers come and ask me money, there is no way, and the bank will collapse. And this also needs to be managed, and all of this is done by RBI. Yeah? Time up, huh? No. We started a little late. Yeah. So, yeah, I think this is pretty straightforward. You have individuals who deposit, you have borrowers who take loans. In turn, bank gives us interest at a low rate, and bank charges interest at a high rate from the person who has borrowed, and that is how it makes money. It's a financial intermediary. Okay, stocks and shares. There is another place where if you have the slight demark and strategy, yeah. There are some very interesting studies that done that. There is not a single expert analyst, financial analyst. There is not a single guy who predicts stock market. They have taken a monkey. They have taken animals. They have taken. There is a way to code a pure random selection. Okay, they have taken all that and they have put the best analysts and they have compared the results. There is no difference. So whether you follow the best expert or you're the you can strategize the best, or you randomly put, apparently it doesn't make a difference. Now, what is a share or a stock? A share is a small ownership of a company. Okay, I'm a small employee, government employee or private employee. I earn little, 60,000. I can never aspire to own a company or big corporation. But through shares, say today there is a small company that is starting in, say, alternate energy fuel cells. Okay, hydrogen-based fuel cells it is creating, or some alternate energy. And I notice the CEO has come out from IIT and then IIM, and credentials look very good. He seems to be pretty passionate. I see the work, it is okay. I see, so whatever. Okay, so when a company is going public, it needs to declare its financials. It has to declare certain things, disclosure antam. So before a company goes public, now what is a company going public? It allows public to invest in its stock. So before it has to disclose. In that disclosure, I read all of that, which is what Warren Buffett does. I mean, Warren Buffett became rich not by investing in blue chip stocks. He did it because he can identify penny stocks. That worth nothing today. But if you put it in the right time, and if you can, what you are saying, strategy, if you can calculate these things, and if you can put the money there, you put 10,000 in, say, Bajaj Auto Finance 20 years back, it would have been 30 lakhs now. And let's not even talk about Netflix and Google and all that. I mean, it would have been insane. If you would have put 10,000, then you would be in crores now. That's the growth that is there. So a small time person, will be able to do that. It's a complicated market. I mean, there is huge risk. Somebody at that time must have then seen Yahoo growing and must have put in it, and then, at some point Yahoo fell. At some point, what are those photocopiers? Xerox as a company, its stocks fell. Nokia, 15 years back, Nokia was the leading, before, we never imagined Nokia to fall. Nokia fell. So, there is that risk. So remember, bank is without the risk. In case of stock market, you can directly see what are these guys are also doing. Who is this borrower? I just told you, it is nothing but a company. This borrower is only a company. Just that now this fellow is mediating and reducing the risk between them and us. Vallaku kuda risk takkuva, manaku kuda risk takkuva. But in this case, you directly give to the company and you buy a stock, you buy a share. So, yeah, it is like directly giving to a friend. So ownership in a corporation, traded in organized markets called stock exchanges. Right now, this is controversially in the news for whatever is happening. And so these are stock exchanges. These are these are like street corners where earlier people used to come and bid. Okay, so earlier, let's say I had a piece of t-shirt, I could go to a street corner and say I'm selling for 50 rupees, 50 rupees first price. And then that's why it is even today called bid price. Okay, and then somebody will say, whoever is asking will ask, and he'll say, I will give 60. So I'll say, okay, 60, 60, 60. Somebody will say, no, I'm willing to give 70. So that is how trading happens. Only thing, all of this is organized, and that organization is done through stock exchanges, whether it is New York Stock Exchange in New York, London Stock Exchange, or Bombay Stock Exchange, BSE. BSE and NSE are major national stock exchanges. And through those stock exchanges, you can invest in shares. Savings becomes, ikkada idi savings gaadu. Ikkada directly idi investment. You are investing. There is high risk and volatility. Obviously, stock market, after the Russian and Ukraine crisis, the stock market fell. India's stock market also fell, which means your shares in roughly any company 2 weeks back has just gone down by a few percentage points, okay? Which is never something that will happen in a bank. A bank is stable. Keyword, stable. Shares, volatile. You are open to that risk that is there. But when you get profits also, you get like that. Okay, now the question, which form of investment usually spreads your money over the largest number of investment projects? A bank account or stocks? Did I not ban you? Okay. So you are putting money. In which case is it most spread? Banks, not stocks. Most investment projects. In stock, you are putting in whatever company, 1, 2, 3. But when you put in a bank, the bank lends to hundreds, thousands of projects. So your investment is spread. If you are investing in share market, the first thing they tell you is diversify. Because if you diversify, you are going to reduce risk. The most diversification happens in case of a bank. But then it is so stable that the return is very, very less. Okay, it is just, usually they just give inflation kanna oka 2 pointlu takku istaru ante, like, no, because otherwise if they don't even give that much, what will happen? Your money is going into, the value of your money is going into negative. If you put 100 and 2 years later, because of inflation, the real value of that money has gone down, right? They may give 100 back to you, but earlier with that 100 I used to get 2 liters milk, now I get only 1 liter milk. So the real value of that money has gone down. So they have to give at least inflation ki deggarga unna interest rate iste, at least what I put is coming back, closer to that, okay? Now, the third kind of a financial market, we have seen banks, we have seen stocks. The third kind of financial market is called a bond market. Now, bond market is, in bank, a bank is a proper intermediary. It ensures stability to you. In case of share, you are directly investing and you are a part owner of that company, okay, which means you are very volatile. There is a third instrument where reputable institutions. Okay, now the thing with banks is anybody can borrow from a bank. Anybody can borrow from a bank. Credit card gavachu. Whether today you just walk into any store, Chroma, whatever you want, walk into, you just say, I want that TV. They're going to take your PAN, type, and then within few minutes, they will tell whether you can get loan or not. If you can get loan, you can take it on credit, and easy installments without any interest. They are giving these services. But bonds are something that can be given only by institutional players. And the biggest bond player is the government itself. In the West, in developed countries, in developing countries, everywhere, governments issue bonds, but private players also issue bonds, big companies. Now, what is a bond? Bond is you lending money directly to the borrower, not through the financial intermediary. Okay, but you are now lending money. You are not a part owner or anything, but you have removed the financial intermediary in between and you are directly lending money to the institution. Now the institution can be government. So bond is nothing but I owe you. No? When I give you a bond for 10,000 rupees, it means I owe you. When I give you a bond for 10,000 rupees, it means I've taken 10,000 rupees from you and I owe you 10,000 rupees. Yes, that's what it means. Yeah, risk factor, it is slightly more than the banks, but the interest rate is also, usually bonds will give about FD say 1-2% jada. Okay. Again, it depends on how stable and secure the bond is itself, and also how long you are willing to invest. There are government bonds that are for 10 years, and there are government bonds for how less? What's the least? 90 days. You can just put it for 90 days also. Now obviously time takku aithe bond yokka return kuda takku untadi, less interest rate. Ade if you are willing to take a bond for 10 years, you will get much better interest rate. You will get even better than FD actually interest. But these are usually stable. So say a company went bankrupt. A company is not able to handle anymore. No, it did not look at its liquidity properly. It didn't keep enough cash. Russia attacked Ukraine. US put sanctions on Russia. My client is in Russia. Russia didn't make payment to me. Now I don't have the money. All my debtors came. I have filed insolvency. I said Chetalitesan. Telugu ledo antaru danni. Divalete, okay, but there's one more term. Yeah. So whatever. So I say I'm done. Once I say that, the court or IB, yeah, IP actually, IP petition, yes. What is it? I think it's insolvency petition. Yeah. So insolvent. Okay. I think you get it. It is liquidity. Liquidity means water is there, and insolvent means it's not. There is no more water left. There is no liquidity. Okay, it's insolvent. If it's insolvent, there is no liquidity and there is a problem. But that doesn't mean there are no assets. There are still many assets left. Asset ante enti? Vaadi building untadi, cubicles untayi, computers untayi, land untadi, వీడికి డబ్బులు ఇవ్వాల్సిన వాళ్ళు ఉంటారు, ఇవన్నీ ఉంటాయి కదా. Now once those assets are there, in which order do you have to pay those assets? Who has greater say on those assets? Once you liquidate, then there is a committee that is set up. Usually if it's a big corporation, there is a committee that is set up, and that committee will sell these assets in the market, take that money and distribute that money to the people whom the company has whom it has to give. So first, whom does it give? Banks. Because they were supposed to be the safest. So akkadi ichina vallu first వెళ్ళిపోవాలి, తర్వాత బాండ్స్, తర్వాత షేర్ హోల్డర్స్ వస్తారు. ఎందుకంటే వాడు ఆ రిస్క్ తీసుకున్నాడు. హీఈస్ ది ఓనర్. హౌ కెన్ ది ఓనర్ ఫస్ట్ టేక్ ద మనీ అండ్ రన్ ఆఫ్? Because he took the risk of doing the business. His comes last. Okay, somewhere in between comes government dues. So now so you have bond market, you have corporate bonds, you have you also have to value your bond. You have government bonds, which are the most common kind of. Westlaw, there are also municipal bonds. I think now, so remember when Chandrababu Naidu was trying to build Amaravati, he raised bonds. I don't know if you remember this or not. He raised a lot of bonds for the construction of Amaravati city. It was fairly innovative. In India, it's not very common for local governments to raise bonds like that. And he did. I remember my mother investing in Sardar Sarovar project, bond, 25 years. Very good returns, very good interest and very good returns. Now, okay. Now, there are credit rating. Now, how do you know whether a bond is secure or not? There are credit rating agencies that come and they rate know how good or how valuable a bond is. They study your assets, they study your liabilities, they study your financial statements, they study your books of account, profit, loss statements, last 5 years, 10 years, మొత్తం analyze చేసి, they come to a conclusion ki you are a very safe company to invest in. Then they give a rating to your bond. They say you are a AA rated bond, you are a AAA rated bond, you are a BB rated bond. Government bonds are usually very highly rated because a government is not going to go insolvent. Okay, it can just print money if it wants to. So those are the credit rating agencies. They play a very important role also in collapsing an economy. Now, inflation. Once you have these, so till now we have done financial markets, but financial markets kaakunda mana life ni direct ga affect chesedi. Financial market has a lot to do with our savings. Okay, you want to save it in less risk, you put it in a bank. You are willing to take risk, you are aggressive, you put it in share market, you are somewhere in between, you put it in bonds. Yeah. Other than that, another thing that affects our everyday life is inflation. Okay. Here this man, very wise man, Robert Mugabe, Zimbabwean president in 1990, there came a time, so he was also a pretty corrupt politician. He owed a lot of money to a lot of people, and he decided the best thing to do is just print it. And he started printing. He was the president then. So he started printing the Zimbabwean dollar left, right, center. And he printed so much that the value of the Zimbabwean dollar fell. And that is a picture of trying to buy, I think, 1 kilo rice. These are notes. These are piles of notes. The picture quality is so bad. But yeah. Each of that is a bundle of $100 Zimbabwean. Each note is $100 Zimbabwean, 100 Zimbabwean dollar. And bundles, this much you need to buy a t-shirt or to buy a kilo of cereal. This is the extreme ugly face. There was a time when even China went into inflation. It can be stupid. I mean, the value of the money is falling. You get it, right? Like it can fall to the point where yeah, so this guy had this brilliant idea of why can't we just print money and eradicate poverty? I mean, it's not actually, I remember as a child when I first time got introduced to money and all that in my 10th standard, I had the same doubt too. Like, yeah, why can't we just print money? What is unfortunate is the president of the country thinking like that. But I guess whether in democracy or dictatorship, every once in a while we have leaders like this. Great economist. Now, inflation is important. I have already given a detailed explanation of why inflation messes with price as a signal, and price as a signal is sticky. Once something gets a price, we are psychological beings. As soon as the markets change, the prices can't change. So there is a disharmony between the price that a commodity is signaling and what is happening in the market, and therefore the entire market collapses. Now, I don't know whether you understand the fundamental of a free market economy as opposed to a socialist economy. A free market economy is based on a belief that information is distributed and decentralized. Hundreds, millions, in our case, 1 billion people have different sets of information. There is no way to coordinate all of this information. A command economy tries to do that. A planned economy tries to think there is somebody, there is a planning commission who can centralize the sit and decide all of this. A capitalist economy or a free market economy assumes that price is a good indicator, and price changes depending on, because on any product, no person can have full idea except the people who are closely trading with it and buying it and using it and selling it. So they will determine its, let the market forces determine its price. Okay, and the assumption is that you cannot centralize this information. Okay, that information on each commodity is distributed across several people. A farmer might better know what is a particular rice ka quality is good or bad. How will I know? No, so dani ye rate lo price cheyalanadi, he is a better judge than I am, no matter where I get my economics degree from. Okay, But to assume that because I have an economics degree, I can tell its price, I can fix its price, is distorting the market, and that is trouble. That is problematic. You can only be an umpire to ensure that people are playing fairly. The moment you start fixing prices, which is the problem that we have with MSP, although again, theoretically MSP is minimum support price, but actually what happens is it becomes the maximum ceiling at which food grains are sold. So you are fixing prices, and how can you fix a price? Okay, yeah, you're distorting market. So when we say this, when these terms are used, distorting market and free market economy and all, we are referring to these aspects. So remember, price is it carries in it an information. Okay, and even if you do not understand entirely what I'm saying, it's okay. This is too theoretical and not necessary for UPSC. But if you can understand, you will better appreciate the. Like I said, you will be able to better get the intuition. All right. So inflation. The questions are mostly related to also indices. There are two kinds of questions on inflation. One is interconnection. If inflation happens, what will happen? What will happen to stock market? What will happen to investments? What will happen to savings? What will happen to bank rates? What should the RBI do? All these things. What should the government do? Fiscal policy ఏం చేయాలి? Inflation అవుతుంది అంటే. So, interconnections with inflation. Two, indices. CPI, WPI, what are the differences? What is in the basket? What is its weight? What is weighted more? What is weighted less? There are only 4 or 5 indices. Don't go deeper than that. Okay, so basically we focus on these two. There's a full chapter on this, so I'm not going into further details. Prices is the next big problem. Why is inflation a problem though? We studied it's because inflation affects the price, and price is a signal. It means you're distorting that signal. Okay, that is why inflation is a problem. You have distributed information at the root of free market, and that is the opposite of command economy. This year's economic survey in chapter 1 and in the introduction preface clearly decries, it criticizes planned and command economy. It calls it the waterfall model, and it says we are following an agile model or barbell strategy, and we are using a different model, and they are against command economy. So it is good if you know, again, all of this part what I just told is not relevant, but if you can understand them, you will, when you're reading a paper or when you're reading an article, you will understand. That is the philosophy beneath it. Okay. If the consumer price index is 93 in 2014 and 97 in 2015, calculate the rate of inflation from 14 to 15. A basket of goods cost me 93 in 14 and it cost me 97 in 15. It cost me, the same basket cost me 4 rupees more. Okay, can anyone tell what are all there in CPI? Goods and services. Rough ga cheppandi. Em goods and services? Steel unda? Consumer doesn't buy steel, no. Fuel, food. These are the big, these are weighted. So again, say in 100 rupees, you spend considerably on, you spend a lot on food, you spend considerably on fuel, clothing. So all of this part make CPI basket. Okay. So obviously it's not 4% because it's not 100. So I doubt if it will be 4%. It can't be this also. Just eliminate. 4.3. Okay. 4.3 it is done. I don't know. 4.3. Okay. So price changes with inflation. Okay. There is a price change. It signals inflation, or if there is inflation, it means prices are changing, and we want to keep prices stable. Also because when I start a business or I take up a job, and once I've taken up a job, I get money every month, so I've taken a loan, home loan, and bought a house. Excuse me, sorry. If price keeps changing, then all of this assumes, okay, capitalism assumes a very rational system. Capitalism assumes a very rational system. It is not running on the whim and fancy of, a lord or something. It is a very predictable system. You want to make it as predictable as possible. So when I am borrowing 1 crore loan from a bank, and a bank is giving me 1 crore loan to start a business, to make pens, I calculate ki I will produce with this 1 crore 100 pens or 1 lakh pens of 10 rupees each, and that makes it 10 lakhs per month, 10 lakhs per month, and in a year I make 1.2 crore, and therefore I pay the 1 crore back and 20 lakhs is my profit. I'm making a very simple, but you follow this logic, right? This is very, very simple. But imagine due to recession or for some other reason, for deflation, actually not recession, deflation, the price of the pen fell from 10 to 9, or even worse, if it becomes 8. Then what will happen? Ultimately, I'm going to create 96 lakhs, which means I'm not able to repay here. I default, which means the bank that gave me is in trouble because the loan has defaulted. Everything gets affected. Okay, which is why we don't want unnecessary distortions in price. We should be able to, the reason why we want prices to be stable is because all of economic activity in capitalism assumes continuity. You should be able to predict when you make, the first thing, when you make a business proposal, there are projections that tell you, okay, this year I'm going to invest on my investment, I'm going to get this much return. Second year, I'm going to get this much return. Third year. All of this assumes prices are going to be stable. You will factor in some inflation. You will say, okay, there is a 3% inflation or a 5% inflation. But suddenly 1 year, like that Zimbabwe president, somebody does something and there is a goof up and there is 100% inflation. All these numbers are gone for a toss. And that is not good at a system level. And that is one problem that we have, price confusion. Also, there will be money illusion. Basically, these financial intermediaries that are there, if prices start distorting like that, they will fail. I just told you why the bank will then not get what it is due. Or even if it gets in nominal value, say there is inflation and in nominal value it gets, but remember in inflation, the guy who gave the money is at loss. Okay, because the real value of the money is going down. So for the bank, it is a loss if there is too much inflation. So all these reasons, it's more complicated, but this much is enough, I think. So which is where the monetary policy comes into place and it ensures price stability. The monetary policy in case of India is Reserve Bank of India. Usually they are called central banks. They are regulator of banks and financial intermediaries. Okay, they are regulators of banks and financial intermediaries. They are the lender of last resort. If the bank is going to fail, they will give the money. Or if the bank has nowhere else to go, if its reserves have dried, if it is illiquid, if it is going insolvent, it will come to the RBI and the RBI will provide that money. And it has various instruments in its kitty. Name a few instruments. Louder, louder. CRR, SLR, repo, reverse repo, bank rate. Yeah. That's it. Now understand when you are reading them, what are they? OMOs are different. Ivanni Guda, different instruments that it has in order to regulate the money supply in the economy. Money supply, not just M0, not just cash, but other money as well. Deposits and treasury bills, bonds, all of that. Vatni regulate chese instruments. Read them and we'll understand. Of course, we are also going to touch them when we do. Fiscal policy, it's a government's policy on taxes, spending and borrowing. Yeah, this is different. I think, okay, two more, this and the next one. So fiscal policy is government generates revenue and it spends. Both of that is part of fiscal policy. Government as a big economic player, can direct the economy in certain ways by changing the wheels. Okay, it can move the wheels, it can't change the wheels, but it can move the wheels. It can decide to consume a lot. It can decide not to spend. Okay, in doing both, it can complement the efforts of RBI, monetary policy, and ensure. But remember one thing, the goal of government is growth. If you like it, you can call development, but basically economic development based, growth based development. The growth of the goal of RBI is stability. Now they are not at crossheads. Okay, they are not opposites, because if you don't have price stability, another problem with price stability is the poor man gets affected worse because of price increase than the rich man or an average middle class man, and that's another problem. That's a developmental problem. All right, so fiscal policy deals with what is it that we can, how can we raise money or how can we spend money in a way so that we are ensuring that the GDP is growing year after year. GDP is our bigger target, okay, for fiscal policy, growth and development. The assumption is growth will lead to development. We will stick with that assumption. Is typically aimed at mitigating. Okay, now one of the things that it does is there are business cycles. I've actually taught this concept, counter-cyclical fiscal policy last time. So there are business cycles, and when there is a boom, it tries to contract its expenditure. So it spends lesser. So as a very big player, in India it is the biggest consumer, if it pulls back its expenditure, what will happen? And if it starts taxing, then the boom is going to go like that. But when the bust comes, because it is being able to, at this stage, it took, which is what happened, there were a lot of people who were asking why India is charging so much taxes on fuel. But that time we were able to do it. So now when global crude prices are going to go up, we have some cushion. Because now up taxes collect JC, the economy boom, it would have grown even better. But now when the time came, now global crude oil prices are going to skyrocket. And now it can take a cut in the taxes, it can take lesser percentage of taxes and ensure that the bust just doesn't go down like that. So what it does is, it makes this extreme fluctuation lesser. In some ways, it is also stabilizing the economy, but not just the price. It is stabilizing the business cycles itself. Okay, what are business cycles and all we will do later. Expansionary versus contractionary. Fiscal, like I said, if the economy is collapsing like it was in COVID, it is not moving, no sales are happening, no one is producing, factories are shutting. At that time, it will try to expand. Like this year, it is expanding. It is really spending a lot. It will try to expand. But say economy is booming and it's doing really well, and people, sentiments are high, animal spirits are good, people are investing, they're taking risks, they're aggressive. Then it will tax people and it will spend less. So taxing people, it will draw money and it will spend less, so it will keep it. So that way, it just doesn't go boom. That is fiscal policy. We're going to see those. And then finally, external trade. There is trade and there are payments. Payments are more than trade. Trade is purely export and import of goods and services. Okay? But you can have payments coming in, because right now, balance of trade, are we deficit or surplus? Deficit. Why deficit? Because we import more. Merchandise. Now import and mali be careful. Services are goods are. Goods or merchandise. We import more than we export. So we are at a deficit. Including services, we are still at a deficit. Services, are we at a deficit or only services? Surplus. Net services, we are surplus. Net services is import is less than export. We are at a surplus. But even this surplus is not able to counteract the deficit here. So we still have about 1% deficit. However, we have a lot of foreign investors who are investing in India, both through FDI and through FII. So much investments are coming into India. So they are investing in our stocks, for instance, through FIIs. They are directly coming and putting factories, or actually not so much factories, but retail stores. India is a consumer market, and and service sector. They're definitely putting software industries and education industries and all that. So they are coming, and so you hear all these news of Byju's getting so much, some startup getting so many $1 million. A lot of those millions of dollars are coming from abroad. Yeah? No, crowdfunding is different. Crowdfunding is like stock market. We are all funding. Just that we are not part owners. It is like bonds. Okay, they owe to us directly instead of through a bank. That is different. This is different. This is them directly coming through a financial intermediary, either through a bank or directly coming and investing in a factory. Now, once they do that, those investments are bringing. So in all of this, the problem is we don't trade externally in rupee, right? We have to trade in dollars, and those dollars are limited, which is the problem. Were we able to trade in rupees? There is no problem. Is there a way to trade in rupees? Aithe? Then what? Yeah, who said? Masala bond. Masala bond is a way in which you can trade in rupee. That doesn't work, Pawan. We'll have to figure out why. We will do that in the external trade wala class. But what you are saying doesn't work, because ultimately the money has to leave the country. And the moment when it leaves the country, it has to go in dollar. What will you do sending it in rupee? What will he do buying it in rupee? There's no value to it. So those dollars, which is the foreign exchange reserve, every month, if it is in deficit, it's a problem, which is why we need surplus. And after a long time, we are sufficiently in surplus. We are so much in surplus that I am guessing a question this year in UPSC prelims on the surplus, BOP surplus that we have. So, yep.